If you don't understand liquidity, you do not understand trading. Why? Because liquidity is the only reason these markets move. It's not because of VWAP, it's not because of market structure, it's only for liquidity. And liquidity is literally the only thing you need to be a consistently profitable trader. And I've spent years studying trading. I failed for literally 4 years. I didn't make a single penny. I lost thousands of dollars. I blew so many accounts. I paid for every course, mentorship, signal service. And I studied all of ICT stuff. I'm a chartered student. I can honestly say the only concept I use is liquidity. 95% of what I've learned was a complete waste of time. Liquidity is all you need to be a consistent, profitable trader. And I know there's many people out there saying, "Oh, I already understand liquidity." But the reality is, and I'm saying this as like your mate trying to help you out. If you're not making at least 10K a month from trading consistently, you do not understand liquidity, at least not fully. So in this video, I'm going to clarify what liquidity is, and more importantly, how you can use liquidity sweeps to get into the best trades possible. Okay, so what is liquidity? We hear all this talk about liquidity. What actually is it? It's simply, where are the stop loss orders, right? That is it. That's all liquidity is. You've got to ask yourself, where are the stop loss orders? Because these markets will only move for where the money is, right? Very, very important. Make sure you write it down that these markets will only move for where the money is on the higher time frames, because these markets, I'm sure everyone knows, are moved by big banks, big insurance companies, hedge funds. They're the ones who move markets, right? If you want to move euro dollar, the S&P, any major market, even crypto, you need billions and billions of dollars. And the only way these institutions with billions of dollars can get in and out of their positions are at key highs and key lows on the higher time frame. That's where all the money's going to be. That's where all the stop loss orders are going to be. And the reason there are stop loss orders, and we all know this, is because of support and resistance, right? We all heard, that price at this level here is key resistance because we've got a high here and high here, high here, high here. So what they think, or what traders think, that price is going to come up like it's done here, and it's going to bounce off, right? It's going to bounce off this level and go down. Now, if you've been trading for more than 3 months, that's a complete load of BS. It does not happen. What actually happens is that price smashes through these levels, right? The only reason we have equal highs here is just to generate liquidity, right? Just to get people to start shorting the euro dollar so we can smash right through it. That's the only reason these highs are impact, right? So that is what liquidity is. That is literally all liquidity is. And the only reason these markets are going to move are for these higher time frame stop loss orders, right? Because there are hedge funds that have their stop loss orders here, right? And you might not believe it. You might think, "Oh, doesn't everyone know about liquidity?" Trust me, there are so many hedge funds. There's essentially 2 ways of looking at it. First, there are hedge funds that have literally a 10% win rate or below, and then they aim for massive trends. They're going to hold for years. As day traders or swing traders, we don't want to hold for years. And they're looking to capture, massive trends over years, and they're happy to get, lose 9 times out of 10, and in the one trade that they do win, they hold on for years and then get like a 20 risk reward ratio. That's one type of hedge funds. The other type of hedge funds, and you've probably heard this stat where it's like 90% of hedge funds underperform the S&P 500, and they make the majority of their money from churning. Now, what that means is the hedge fund makes their money from getting in and out of positions, right? They make all their money from commission, not from actually making a return for the investors. Now, I'm not going to talk too much about that, but trust me, I worked at a big bank, and these big banks will literally rob investors of their money. They make all their money from commissions. They don't care whether their investors lose or win. They don't give a shit. They make all their money from. But anyway, all you need to know for trading is that at these highs here, there is so much liquidity, there's so much stop loss orders, and that the market is going to move for this, right? That's all we need for liquidity, right? All liquidity does is it gives us the direction of the market. So hopefully, clearly, we're bullish and we're looking to target these highs. So we're going to look for longs on euro dollar until we take out this high, right? And then we'll see what price does, right? If price just smashes right through, then okay, we'll look for the next liquidity over here. But if we get some consolidation like this, we'll just wait a few days and then see what price it does. Because they want to go up, or is it going to start reverse, right? That is all we need for liquidity. Liquidity gives us our direction. Now, most people, maybe if you look at liquidity, you might understand that. You probably understand that. Now, hopefully that makes sense, right? Markets will only move for higher time frame stop loss orders. It's the only way big banks and big, insurance companies, hedge funds can get in and out of their position. What liquidity does is it gives you the direction of the market. We know the direction, we know we're bullish, but that alone is not enough to make money, because for years I could get the direction right, but I couldn't make money. And the reason why is because I didn't wait for the liquidity sweep. So I'm going to get a lower time frames. I'm going to show you what a liquidity sweep is and how you can enter on the highest probability trades possible. Okay, so run the lower time frames now, and I'm on the 1 minute chart. You can use this, the liquidity sweeps will be on literally every time frame, but the lower the time frame, the more liquidity sweeps are. That's why I'm on the 1 minute chart, because let's say you're on the 5 minute chart, you can't see liquidity sweep. Go to the lower time frames and wait for one. Now, what a liquidity sweep is we know the higher time frame direction. Like we know, we looked at liquidity. Liquidity is all the way up here, right? So we just want to trade in this direction, right? We just want to look literally any sort of opportunity to get long, right? We want to buy the dip essentially. But yeah, that alone isn't enough, because how many times has this happened, right? How many times have you tried to buy the dip, right, on a fair value gap, order block, VWAP, and EMA, and the price comes down, it takes out your stop loss here, this is where your stop loss is, and it goes straight to your take profit. Like, that used to happen to me all the time, and it's so annoying. Now the reason why that happens, and this held me back for 4 years, this is the reason why I couldn't make money, because I had no idea about liquidity sweep. The reason why is we need to wait for something called a liquidity sweep. So what a liquidity sweep is, and I'm just going to show you for this blue line here. So let me just show you here, right? Let's imagine this is where people would put their stop loss orders. What you're going to do is you're going to wait for this stop loss here to get hit, and then you're going to wait for price to show you that it's bullish, and then we're going to enter on a high probability retracement here, right? Because if price came, take out this stop loss, very, very unlikely that price can come all the way down and take out this stop loss again and then go that way. And I'm going to show you what that looks like in the candlestick charts. But let's just remove this, and then what we're going to do is we're going to the 1 minute chart here. So if you can see, if you remember what I just showed you up there, right now we know we're bullish, right? So this is the most important part. We've got the direction. We're not even looking for shorts. We're not looking for any opportunity to get short. We're just looking to get long, right? And we're waiting for a liquidity sweep, right? Almost like a sniper. We're literally waiting for it. We know what we're looking for, and we're waiting for it. Lots of people, and if you don't know what a fair value gap is, that's fine. Lots of people are going to start selling when price gets this fair value gap, because they have no idea about liquidity on the higher time frames. But you guys, you watched the video, you know exactly what liquidity is. So we know we're bullish, and what's actually happening is at this low here, lots of people, as euro goes up, they're going to be buying, and they're going to put their stop loss right here, because that's what everyone says, say stop loss, put it at the old low. So at this low here, lots of liquidity, and what we see is price has gone off all the way like that. It comes down. Look at these wicks here, right? Look at the wicks here, and I'll make it a bit more obvious. It just wicks below this low here, taking out anyone who had their stop loss orders at this level. Anyone who had their stop loss around this level here, right? It price wicks down, takes out their stop loss, and then quickly and aggressively moves on, right? Literally so aggressive, I have to zoom out of the chart, right? It goes all the way up there in the opposite direction, right? That right there is what we call a liquidity sweep, right? That is what a liquidity sweep is. Now I'm going to show, let me just get this really obvious, right? See this wick here? This wick here is your liquidity sweep. At this low, people have their stop loss orders, right? Because the price went all the way up. This wick literally pokes down, takes out anyone's stop loss orders who are here, and then massively and aggressively moves in the opposite direction. Now, the reason that happens is because smart money, right? Big banks, big hedge funds, their algos, so an algorithm, right? Trading bot is coded to enter at these stop loss, right? So at key highs and key lows, as soon as price comes, but I think it's like, I don't want to get too much into that, but it's something to do about the standard deviation or like Fibonacci or whatever. But as soon as price takes out these old lows or old highs, they're buying. They're buying, because they know people can have their stop loss at this low, at these highs. The price comes down, takes out their stop loss. This is where my stop loss used to be, where your stop loss used to be. People will think, oh, there's an order block here. I can enter on this order block. Price comes, takes out your stop loss, and then goes in the opposite direction. Now, what we want to do, if you remember what I showed you on, with the blue line, so what we want to do is we've got our liquidity sweep, we've got the higher time frame liquidity all the way up here. All we want to do now is we want to enter on some sort of retracement. So we've had our liquidity sweep. This was a liquidity sweep. Price has clearly shown us that it's still bullish, right? It's not just consolidated for ages around here. It's not gone like this. It's shown us clearly and aggressively that price is bullish. At this point here, we want to start to enter on our trade, right? We want to look for some sort of retracement anywhere, at this point here. There's fair value gaps, order blocks, but for me, I'm going to show you the easiest entry that I think is possible, that I've used to become financially free, and it works on all time frames. So all you're going to do at this point, and let me just emphasize something that's so important. If you've got liquidity on the higher time frames, like we have all the way up here, right? So if you've got liquidity on the higher time frame, you know where price wants to go overall, you've got your lower time frame liquidity sweep. Any entry pattern after that is super high probability. I know I bashed on the VWAP at the beginning of the video. I hated it because I spent money on this course and it held me back about a year. So any entry, like EMA, moving average, Bollinger Bands, VWAP, value gap, or like I like, which I think is the best entry, and after you've got all this, right, is a simple Fibonacci retracement on this low, this high, right? No guesswork. We're not guessing where to enter. You just place it like that, right? There's no guesswork. We know exactly where we want to enter. And for me, those who are going to ask, I enter at this level every single time. 0.705 level. So pause the video. This is the exact level I've used to become rich, financially free There's no magic in this number. It's just a nice way of just entering a trade. And I backtest this for literally 2 years at least, right? I backtest this. This is probably the best number you'll get with Fibonacci. And then what I'm going to do, and I always do this, right? I don't guess about, where am I going to enter and all that sort of stuff. I enter at this level. My stop loss is always at this low here. I'm going to talk a bit more about this in a minute, why your stop loss should be here. And for my take profit, I enter for a free risk to reward ratio. That is all I do on a day in, day out basis. And I was a day trader for years, almost 4 years right, as a day trader. And I'm very busy now, so I'm a swing trader. I use this exact same model, this exact same step I just told you, except forget it's the 1 minute chart, replace it with the 4 hour chart, right? That's what I do now, right? I'm a swing trader. I day trade on the 1 minute chart. I'd scalp on the 1 minute chart. I day trade on the 5 minute chart, the 15 minute chart. Every time frame, apart from the hourly chart. I've not got too much experience with the hourly chart, but I'm sure it works there. It works on every single time frame. Even on the daily chart, you can see it. Now, if you remember, I said you have to put your stop loss at this low hit. Why? Why do we have to do that? This is so important. So many people will get literally every single thing right. They'll wait for liquidity sweep at the higher time frame direction. They'll enter the retracement. But whatever reason, they're obsessed with getting a massive risk to reward ratio, right? And they'll put their stop loss maybe like here, or even at the fair value gap here. The price will hit their stop loss and then reverse. We put our stop loss at this low here, right? Because it's very, very unlikely. This was a liquidity sweep. That price is going to come all the way down, take out this low again, and then go in the other direction. Very, very unlikely. Because if you remember, let's just remove this. The only reason this exists here is just to take out these stop loss orders. That's the only reason price came down, take out stop loss orders, and then go in the other direction. Very, very unlikely price can come all the way down, again, take out your stop loss, and then go off in the other direction. We've already waited for it. So that is why your stop loss being here is so high probability. Do not, and I see so many, not so many, but I see a few people DMing me on Twitter or X, and they're saying, oh, I got everything right, but my stop loss was here, or it was at this fair value gap here, or at this order block here. I'm like, what are you doing, bro? Just put it at this, this low. The whole reason we wait for a liquidity sweep is so we can put our stop loss in the safest, highest probability area of not getting hit. Right? So we don't need to finesse our entries. If you're doing this strategy and you're doing it right, minimum, absolute bare minimum, you'll be getting a 50% win rate and 2 risk to reward ratio. Minimum, right? And if you're using the optimal trade entry, 50% win rate and 3 risk to reward ratio. Bare minimum, like absolute minimum, right? And there's some people who think that's insane, that's way too high. Yeah. Let me tell you something, that is not too high at all. And that's very realistic as well. Anywhere between 40 to 60% is very realistic in trading, right? But ignore anyone who's like, 100% win rate or whatever. But all you're gonna do at this point is you're just gonna sit, put your limit order up, or you can market order if you want to, and let price do its thing, right? Let price do its thing. Right, so here's my entry. You get tagged in, let price do its thing. Let it do its thing. Like, don't worry about the retracement. There we go, right? Like that. So let's just pause it. Like that. Right? All the way up here. And, let's just see actually. Do we have to take out this liquidity on the day? Set consolidation. Doesn't really matter, like, because I always close my trade at a free risk order. Yeah, and it looks like we're just going to consolidate, right? So, and somebody will ask me this, like, hey, do I have to target this liquidity on the day? No, not at all. Target a 2 or 3 risk reward ratio. That's all you need to be a profitable trader, right? Don't hold for ages. Don't try and guess. Don't think, oh, I missed out on all this here. Look, listen, be happy that you get free, be happy that you hit take profit. Be happy that you hit take profit. Don't think that you need to hold trades. And people ask me about partials and stuff. Look, I'm not taking partials, 2 risk reward ratio or any of that. Even break even, I move my stop to break even at this point here. Right, so the moment this candle breaks through that, my stop loss goes to break even like that, right? And then I obviously have got the free risk reward ratio, whatever that is. The reason why is I found in my backtesting, and you should always do this in your backtesting, I found that when price took out this high, literally 19 times out of 20, it would hit the free risk reward ratio. Very, very, very rarely does it do this, right? Did it come all the way down and hit my stop back, right? So 1 in 20 times it would take out this cut and then take out my stop loss. So, yeah, very high probability trading. And that is how you use liquidity in trading, right? The first thing you have to do, this whole thing falls apart if you don't have the higher time frame liquidity. You have to know where the higher time frame liquidity is. And you do that on the 4 hour chart. And ideally, or you can use the daily chart. But I like the 4 hour chart because it's a lot clearer, right? You find liquidity in the higher time frames, you wait for a liquidity sweep, and then you enter on any retracement after liquidity sweep. It's that simple. And it will take some time. Obviously, to master this and stuff. But luckily, I've made a full free 2 hour trading course where I dive even deeper into liquidity, into sessions, what sessions should you trade, and more importantly, psychology and how to finally fix your psychology forever. And it's not journaling. And if you really watch the psychology part, it will literally not only change your trading, it will change your life, because it changed my life and I became profitable within 3 weeks of learning what I teach in that video. So yeah, go check that out.